The limited partner wanted a forensic review of all valuation models from the past 18 months. Every spreadsheet, every assumption log, every email chain where projections were discussed or revised. My investment director went quiet on the call. I'd spent 14 months building conservative models that flagged liquidity concerns in 3 portfolio companies. I'd presented cash flow scenarios that predicted exactly the kind of crunch we were now experiencing. I'd sent weekly updates with sensitivity analysis showing what would happen if revenue growth slowed by even 5%. None of it made it past my director's desk. When the fund's valuation dropped and our largest LP demanded explanations, he told them the analytical work had been insufficient, that the models I'd built were too optimistic, that I'd missed critical warning signs that should have been obvious. He said this in a quarterly review meeting. I was sitting 3 seats away. I didn't interrupt. I didn't object. I pulled out my phone under the table and forwarded 16 months of time-stamped emails to my personal account. Because when someone throws you under the bus in front of the people who write the checks, and those people start asking to see the original work, the truth has a way of surfacing faster than anyone expects. My name is Victoria. I joined Bridgemont Capital in January 2022 as a portfolio analyst. We were a mid-sized private equity firm focused on lower middle-market industrial and manufacturing companies. The fund I worked on had 12 portfolio companies with a total asset value of around $800 million. My role was to monitor financial performance, build valuation models, and flag risks to the investment committee. The work was technical but straightforward. I'd pull monthly financials from each company, update the models, run scenario analysis, and present findings to my investment director, Kenneth Marsh. Kenneth had been with the firm for 9 years and managed relationships with our 2 largest limited partners. He reported directly to the managing partner. For the first 6 months, everything functioned normally. I'd send Kenneth my monthly reports. He'd review them in our weekly meetings, and we'd discuss any concerns before he presented to the investment committee. The portfolio was performing well, revenue was growing, EBITDA margins were stable. Then, in July 2022, I started noticing something. One of our portfolio companies, a precision manufacturing firm called Apex Components, began showing declining cash conversion cycles. Their accounts receivable were stretching from 45 days to 60 days. Inventory was building. The cash flow statement showed they'd drawn down their revolver by $2 million in a single quarter. I flagged it in my monthly report. I built a scenario model showing what would happen if the trend continued for 2 more quarters. The conclusion was clear. Apex would face a liquidity crunch by Q1 2023 unless management addressed the working capital issues immediately. I sent the report to Kenneth on a Thursday morning. Subject line: Apex Components, Working Capital Concerns. He didn't respond. I followed up in our weekly meeting the next Tuesday. Did you get a chance to review the Apex analysis? I asked. I saw it, Kenneth said. I think you're being overly conservative. Their revenue is up 12% year over year. The receivables extension is just a function of landing larger customers with longer payment terms. It's not a risk. The cash flow impact is material, I said. If they keep drawing on the revolver, they'll hit their covenant limits. They won't. Management knows what they're doing. Let's revisit it next quarter. I made a note in my file and moved on. Next quarter came. Apex's receivables stretched to 70 days. They drew another $1 million on the revolver. The covenant cushion was now less than 5%. I updated my model and sent Kenneth a revised report. Subject line: Apex Components, Updated Cash Flow Scenario, Urgent. No response. I brought it up in our next meeting. Kenneth, Apex is approaching their covenant limits. We need to loop in the investment committee. He leaned back in his chair. Victoria, I appreciate the diligence, but you're looking at this too narrowly. Apex is in growth mode. They're investing in inventory to support future orders. This is exactly what we want to see. The covenants are fine. The covenants are 5% away from breach. And management has a plan to address it. I spoke with their CFO last week. They're implementing new collection procedures, and they've got a large contract about to close that will accelerate cash flow. You don't need to worry about this.
I didn't argue. I went back to my desk and saved the email chain and the model in a dedicated folder labeled Apex Working Capital. By December 2022, 2 more portfolio companies were showing similar patterns: slower cash conversion, higher inventory levels, increased reliance on credit facilities. I built detailed models for both companies and sent them to Kenneth with the same level of documentation I provided for Apex. He dismissed both. "You're building worst-case scenarios that aren't realistic," he said in our year-end review meeting. "These companies are growing. Growth requires working capital investment. You need to adjust your risk tolerance." I asked if he wanted me to present my analysis directly to the investment committee. "That won't be necessary," he said. "I'll handle communications with the committee. Your job is to provide me with the analysis. My job is to interpret it in the broader strategic context." I didn't push back, but I started keeping meticulous records. Every email I sent to Kenneth, I BCC'd to my personal account. Every model I built, I saved with timestamps. Every meeting where I raised concerns, I documented in a contemporaneous memo that I emailed to myself immediately afterward. I wasn't planning anything. I just had a feeling that at some point, someone was going to ask questions, and I wanted to be able to answer them accurately. In March 2023, Apex Components breached their debt covenants. The lender issued a notice of default and demanded immediate repayment of $4 million. Apex didn't have the cash. We had to inject emergency capital from the fund to cure the default and renegotiate the credit facility. The investment committee was furious. Kenneth presented it as an unexpected working capital event caused by a large customer delaying payment. He said management had been blindsided and that the portfolio team was implementing enhanced monitoring procedures going forward. He didn't mention my reports. He didn't mention the scenario analysis I'd sent him 8 months earlier that predicted exactly this situation. I sat in the back of the conference room during the presentation and said nothing. 2 weeks later, the other 2 companies I'd flagged ran into similar issues. One breached covenants. The other had to delay a planned dividend to preserve cash. The pattern was now obvious to everyone. Our largest limited partner, a public pension fund that had invested $200 million in the fund, requested an emergency call with the managing partner. They wanted to understand how 3 portfolio companies had simultaneously experienced liquidity crises without any advance warning. The call was scheduled for a Friday afternoon. Kenneth was asked to prepare a presentation explaining the timeline of events and the firm's monitoring procedures. I wasn't invited to the call, but I was asked to prepare supporting materials. I spent 2 days building a comprehensive timeline. I pulled the original models. I documented when each company first showed warning signs. I included the dates I'd flagged the issues to Kenneth and the scenario analysis I'd provided. I sent the package to Kenneth on Thursday evening. Friday morning, he called me into his office. "I need you to revise this," he said, pointing at the timeline. "Revise what?" "The dates. You're making it look like these issues were visible months ago. That's not accurate. The warning signs only became clear in the past quarter." I stared at him. "The warning signs were clear in July," I said. "I sent you a detailed report on Apex in July 2022. That was 8 months before they breached." "Your report was based on overly conservative assumptions. It wasn't actionable intelligence." "It predicted exactly what happened." Kenneth's expression hardened. "Victoria, I need you to understand something. Limited partners don't want to hear that we saw problems coming and didn't act. They want to hear that we responded appropriately to new information as it emerged. Your timeline creates a narrative that makes the firm look negligent. That's not helpful. You want me to change the dates? I want you to present the information in a way that reflects the reality of the situation. The models you built in July were preliminary. They weren't reliable. The real risk only became apparent recently. I didn't say anything for a moment. I'm not going to change the timeline, I said. The dates are accurate. Kenneth leaned forward. Then I'll present the information myself. You're not required to join the LP call. Fine. I went back to my desk and opened my personal email. I forwarded every Apex-related email, every model, every memo to a separate folder. Then I did the same for the other two companies. That afternoon, Kenneth joined the call with the limited partner. I wasn't on the line, but I heard about it from another analyst who was. Kenneth told the LP that the liquidity issues were the result of unexpected market conditions and aggressive growth strategies by portfolio company management. He said the firm's monitoring had identified early warning signs, but that the analytical work supporting those warnings had been insufficient to warrant intervention. He said the analysts responsible for the models, me, had built scenarios that were too optimistic and had missed key risk factors. He said this on a recorded call with the pension fund's investment committee. The LP asked to see the original analytical work. Kenneth said he'd provide it. Monday morning, I received a meeting invitation from the managing partner, Gordon Hartley. Subject line, LP review, documentation request. I walked into Gordon's office at 9. Kenneth was already there. Victoria, Gordon said, we need to pull together all the analytical work related to Apex, Meridian and Stokes for the LP review. They want to see the original models, the monitoring reports, everything. Can you compile that? Of course, I said. Kenneth mentioned that some of your early models may have had optimistic assumptions that we'll need to clarify. Can you walk me through your methodology? I looked at Kenneth. He was looking at his phone. My models weren't optimistic, I said. They were conservative. I flagged liquidity risks in all three companies months before the issues materialized. Gordon frowned. Kenneth said the early analysis didn't capture the full risk profile. That's not accurate, I said. I sent detailed reports to Kenneth starting in July 2022 for Apex, September for Meridian, and October for Stokes. Each report included scenario analysis showing exactly what would happen if working capital trends continued. Kenneth decided not to escalate those reports to the investment committee. Kenneth looked up. That's a mischaracterization. Your analysis was preliminary. It wasn't suitable for committee review. I have the emails, I said. Gordon's expression shifted. You have the emails? Every report I sent, every follow-up, every meeting where I raised concerns, all time-stamped. The room went quiet. I'd like to see those, Gordon said. I pulled out my laptop and opened my personal email. I had organized everything into 3 folders: Apex, Meridian, Stokes. Each folder contained the original reports, the models with metadata showing creation dates, the email chains, and my contemporaneous meeting notes. I turned the screen toward Gordon. He spent 20 minutes reading through the files without saying a word. Kenneth sat perfectly still. Finally, Gordon looked up. Kenneth, can you give us a moment? Kenneth left. Gordon closed my laptop and slid it back to me. How long have you been keeping these records? He asked. Since December 2022. Why? Because I had a feeling that at some point someone would ask what happened, and I wanted to be able to provide an accurate account. Gordon nodded slowly. The LP has requested a forensic review. They want an independent third party to examine all the analytical work and determine when risks were identified and how they were communicated. Are you comfortable providing these files to that review? Yes. Understood. I'll let you know next steps." I went back to my desk and waited. 2 days later, Gordon informed the investment committee that the firm had retained an independent consulting firm to conduct the forensic review. The scope included all portfolio monitoring work from January 2022 through March 2023. I was interviewed by the consultants for 4 hours. I provided them with complete access to my email archives, my models, and my documentation. They interviewed Kenneth for 2 hours. The review took 6 weeks. The final report was delivered to the managing partner and the LP Investment Committee in late May 2023. I didn't see the full report, but I saw the executive summary. The findings were unambiguous. Portfolio analyst Victoria Chen had identified material liquidity risks in 3 portfolio companies between July and October 2022. The analysis was thorough, well-documented, and accurately predictive of the subsequent covenant breaches and cash flow crises. The reports were communicated to Investment Director Kenneth Marsh on multiple occasions via email and in direct meetings. Mr. Marsh did not escalate these reports to the Investment Committee and did not implement the recommended enhanced monitoring procedures. The failures were not attributable to analytical deficiency, but to a breakdown in internal communication and risk escalation protocols. The LP requested a follow-up call with Gordon. I wasn't on that call either, but the outcome was clear. Kenneth Marsh was placed on administrative leave pending further review. 2 weeks later, he resigned. The firm issued a statement saying he was pursuing other opportunities. I was asked to present my monitoring framework directly to the investment committee going forward. My title was changed to Senior Portfolio Analyst, and my compensation was increased by 30%. The limited partner didn't withdraw from the fund, but they did implement new oversight requirements, including quarterly direct meetings with the portfolio team and mandatory risk escalation protocols. I stayed at Bridgemont for another 14 months. The work was fine. The new reporting structure was better. But the entire experience had clarified something for me. I didn't want to work in an environment where telling the truth required building a legal defense file. I left in August 2024 to join a different firm. Smaller fund, better culture, direct access to decision makers. I still keep detailed records. I still BCC myself on important emails. I still document meetings in contemporaneous memos. But now it's just professional discipline, not self-preservation. Kenneth landed at another firm 6 months after leaving Bridgemont. I saw the announcement on LinkedIn. He's an investment director there too. I didn't send a connection request, but I did think about that moment in Gordon's office when I turned my laptop around and showed him the emails. The look on Kenneth's face when he realized that every conversation, every dismissal, every time he told me I was being too conservative, all of it was documented with timestamps and metadata. The thing about throwing someone under the bus is that it only works if no one can prove what actually happened. And in a world where every email leaves a trail and every file has a creation date, the truth isn't a matter of interpretation, it's a matter of record.